Starting in 2024, Phase 2 of the CPP enhancement is coming into effect. And what that means is that there's going to be a new secondary CPP contribution for higher income earners. So in this video, we'll be going over number 1, who is going to be affected by this change. Number 2, why this is happening. Number 3, how does this affect your paycheck? Number 4, how does this affect your retirement benefit? And lastly, my thoughts on this as a financial planner. So let's get right into it. So who is affected by this change? Phase 2 of the CPP enhancement only affects people who are making over $68,000 or more. That being said, all Canadians have actually been affected by the CPP enhancement, and that's because Phase 1 of it actually came into effect back in 2019. And the changes were subtle and it happened over the course of a couple years, so most people haven't paid much attention to it, but more on this later in the video. And for those who are near or already in retirement, this change does not affect you or your benefits unless you've worked and contributed to CPP in 2019 or later. Now, why did this change happen? Well, the government of Canada has written an entire article on this, but long story short, is because they're finally realizing that most Canadians are not going to be retirement ready if they just leave things as it is. Because typically, a person's retirement income consists of their CPP, their OH security, work pensions if they have any, rental income, and finally their private savings or their investment portfolio. But the problem is most of these are not mandatory for people to save into. For example, OAS just depends on how long you've lived in Canada over the course of your adult life, and work pension largely depends on if your employer even offers it. And rental income or private savings or investment portfolio really depends on the person's saving habit and how much they are saving for their future. But what they're seeing also is there's actually been a steady decline in registered pension plans in the private sector, which means more and more Canadians will need to rely on their own saving efforts to ensure they have enough for retirement. So that's why they're enhancing the CPP, because they believe it will significantly reduce the amount of families at risk of not having enough for their retirement lifestyle, or at least the degree of undersaving. A research study done by Deloitte have also found that only 14% of the Canadians near retirement age are actually financially ready. 18% are confident that they can retire, but will likely need to compromise on some of their retirement lifestyle, and the remaining 68% will be at risk of not being able to sustain their retirement. I don't mean to share these stats with you to scare you, but being aware of what's happening and how common this issue is the first step for preparing ahead and making sure that you don't end up in the bottom 68%. I'll leave the links to the articles and the research study down in the description below so you can check it out if you want to learn more details yourself. But this clearly indicates that most Canadians are not saving nearly enough for their retirement. And this is also in line with what I've been seeing with different clients when they first come to me, no matter what their income level is. The number one reason why this is happening is because for a lot of people, saving for their retirement is not really something on their radar until they hit their late 40s or even 50s. Because this is usually when they've paid off a majority of their mortgage or when the kids are finally independent. But if you think about it, what you're really trying to do is you're trying to use 10 to 15 years of time to save for 30 years of retirement. Now, it is definitely possible, but it's not an easy task at all. And that's why planning early is super important. Because with proper planning, you could have taken advantage of the registered plans, such as RSP, to save for your retirement while saving a ton of taxes throughout your working years. I mean, it's also why it's called a registered retirement savings plan, because the government really wants to encourage you to save for your retirement by giving you extra tax refunds as an incentive. Plus, you could invest those tax savings and let compound interest and time do the work for you. Don't just work for money, make sure your money is working for you as well. Now, how does this affect our paycheck? From 2019 to 2023, phase 1 of the CPP enhancement has already started. And what they're doing is they're gradually increasing the contribution rate from 4.95% to 5.95%. So for example, in 2019, they're increasing it by 0.15%, and then in 2020, another 0.15%, and eventually by 2023, the contribution rate will already be at 5.95%. And if you're self-employed, because you're acting as both the employee and the employer, so you actually need to pay double the CPP amount yourself compared to an average employee. This contribution rate doesn't apply to all of your income though, because they cap it with an earnings ceiling that they call the YMPE, or the year's maximum pensionable earnings. And what this means is that in prior years, you only make contributions to your CPP for any income that's under the YMPE. And for any income that's above the YMPE, you no longer need to pay any CPP contributions. But this is changing this year because in 2024, they're going to introduce a new secondary earning ceiling called the YAMPE, or the year's additional maximum pensionable earnings. So for 2024, the CPP's YMPE is going to be $68,500. Let's call this the first tier so it's easier for us to understand. Then there will be a second tier of the CPP enhancement that will apply between the income of $68,500 to $73,200. So let's look at some quick calculations to see what is the net effect before the enhancement happened versus after the enhancement. So before in 2023, the YMPE was $66,600. So with the contribution rate of 9.95%, then an employee's contribution would be $3,754. And this is the exact number that you'll see on your T4 because that's a maximum CPP contribution that you would make, no matter if you're making $70,000 or even $100,000. Now, compared to after the enhancement, basically we now have two tiers. So the first tier, which is up to $68,500 of income, this range of income, you'll continue to pay the regular contribution rate of 5.95%. But when it comes to the second tier, which is the income between $68,500 to $73,200, you'll be making a 4% contribution into your CPP. Right? The first tier is going to be the same formula. So we take the YMPE minus $3,500 of the basic exemption, then we times it by the contribution rate of 5.95%. That will give us the amount of $3,867. Then what we need to do is we need to add on the second tier, which is the $4,700 on top of the YMPE. So for the income for this range, we need to times it by 4%, and that will give us $188. So when we combine the first tier and the second tier, then we can arrive at the total contribution amount of $4,055. So what that means is if your income is more than $73,000, then you're paying $301 more in CPP compared to last year in 2023. Then in 2025, there will be a final component to the phase 2 of the CPP enhancement where they're raising the YEMPE, right, or we call it the second tier. They'll be raising the second tier of earnings ceiling by another 7%. So if we do the same calculation for 2025, the first tier's earnings ceiling is projected to be $71,200. So the maximum contribution for the first tier is going to come out to $4,028. And the second tier's earnings ceiling, which is projected to be $81,100, the CPP contribution will come out to $396. So if we combine the first and second tier, the total amount of CPP contribution we're looking at for 2025 is $4,424. So if you're expecting to make more than $81,000 in 2025, then you'll be paying another $368 more compared to 2024. And here's a quick glance at the max CPP contribution amounts over the course of years. Like the first tier or the YMPE's earnings limit, the second tier or the YAMPE will also increase each year to reflect the wage growth. So how does all this affect your retirement benefit then? Up until 2019, the CPP is meant to provide 25% of your average work earnings in your retirement years. And this is based on your average earnings from employment or self-employment and up to the YMPE of each year. Now, what the enhancement is trying to do for the CPP is they're trying to make CPP able to provide 33% or 1/3 of your work's average earnings in your retirement years. So your CPP pension will increase based on how long and how much you've contributed into the CPP enhancement. And the effect is that it will increase the maximum CPP benefit by more than 50% for those who make enhanced contributions for 40 years. So for example, the current maximum benefit is around $13,000. And if we look at the enhanced CPP in today's dollars, then it would mean that you're getting an increase of around $7,000. So in today's dollars, you would actually get a maximum benefit of around $20,000. And with this enhancement, the government of Canada expects that it'll cut the retirement income gap by more than half for families who are at risk of not having enough for retirement. So if they left things as it is now, then families at risk are going to be $8,300 short to have a comfortable retirement. And with this enhancement, the same group of people will now only be $3,700 short. Finally, my thoughts on all this as a financial planner. This to me is a win for Canadians because of two reasons. Number one is because CPP is mandatory for all Canadians. It basically forces you to save more towards your retirement. And even with the CPP enhancement and the increased contributions, CPP is just going to be a good base to have for your retirement. And it's really not meant to be relied on for sustaining your entire retirement lifestyle. Like we mentioned earlier, you should have OAS or work pensions or private savings or investment portfolios or even rental income to really supplement that retirement income for yourself. But as we saw earlier, 68% of Canadians are at risk for not having enough. So forcing everyone to contribute more into the CPP will definitely provide more financial security for Canadians. Reason number two is because it also forces your employer to contribute more into your retirement as well. Because employers are required to match the CPP contributions. When you're paying more into the CPP, your employer is also paying more as well. And this is purely for your future benefit. So this change is actually great news because the government is basically forcing your employer to give you more benefits than what they're already giving you. Who doesn't like free money from their company, right? Overall, I think this CPP change will reduce the number of families at risk for not having enough for retirement. But it's only going to help so much because the current percentage is so high at 68%. It's going to take a lot more than CPP enhancement to really cut down on this percentage. And ultimately, it's up to you and not the government on how your future is going to look. So you should really be focusing on your own savings habits and your financial planning to really help secure the retirement lifestyle that you want. And if you've ever wondered how to determine what is enough to retire comfortably or when is the best time to retire, check out our video here on the 5 signs to retire as soon as possible, where we talk about the 4 things to consider besides money when you're deciding when to retire, and also the 3 numbers that you must know to see if you're financially ready. Thanks again for sticking around till the end, and be sure to subscribe to our channel, and I'll see you in the next one.